Norway's $1.8 trillion sovereign wealth fund, how it became a global powerhouse. How did a sparsely populated Norway build a staggering $1.8 trillion wealth fund? This question is not just a matter of curiosity. It reveals the fascinating dynamics of investment, resource management, and national strategy. Among the world's sovereign wealth funds, Norway stands out for its distinct characteristics. While many of these colossal state-linked funds operate by selectively choosing their investments to mitigate risks, enhance returns, and serve national interests, the Norges Bank Investment Management, NBIM, takes a different approach. Instead of a highly curated investment strategy, it predominantly mirrors global indexes. This method allows Norway to convert its oil and gas revenues into a steady income stream. The fund began its journey in the early 1990s with an emphasis on bond investments. Today, it has evolved into the largest sovereign wealth fund globally, having amassed equity stakes in thousands of companies across the globe. With its capital reaching an impressive $1.8 trillion, this fund is now a more significant source of income for Norway's 5.6 million residents than oil and gas extraction itself. However, this dependence has raised alarms. Critics worry that the nation's economy might be suffering from a lack of innovation and dynamism as a direct result of this reliance. Furthermore, the fund's passive investment style has come under scrutiny. This approach can restrict its ability to adapt effectively to the fluctuating nature of global capital markets. For instance, in April, the fund reported its most substantial loss in 6 quarters, as market turmoil ensued due to tariffs proposed during Donald Trump's presidency. #What makes Norway's sovereign wealth fund unique? This fund is differentiated from many others because of its stringent investment policies. One of the most significant rules is that it can only invest outside of Norway. This safeguard was designed to avert the so-called Dutch disease, where an abundance of natural resources can destabilize a country's economy by inflating its currency and making other sectors less competitive. While many wealth funds participate in domestic economic stimulation or undertake strategic investments to bolster their nation's international influence, the NBIM operates within a more constrained framework. Approximately 70% of the fund is allocated to equities, encompassing investments in about 8,700 companies across 44 countries that are part of the FTSE Global All-Cap Index. This portfolio positions the fund as a significant shareholder, owning around 1.5% of all publicly traded stocks worldwide. In contrast, other sovereign wealth funds, like the Abu Dhabi Investment Authority, have more flexibility in their investment strategies. They are increasingly focusing on private equity and data-driven investments, while entities such as Mubadala Investment Co. are pivotal in diversifying the economy of the emirate through investments in sectors like healthcare and finance. Saudi Arabia's Public Investment Fund is directly engaged in the nation's Vision 2030 initiative, making substantial investments in mining, technology, and gaming. Singapore's GICPT is similarly broadening its horizons, now taking on greater risks in the private market space. What are the roots of Norway's wealth fund? Norway secured significant oil and gas reserves in the North Sea in 1969, emerging today as Western Europe's predominant fossil fuel producer. To protect against the instability, corruption, and sluggish economic growth witnessed by other resource-rich nations, the Norwegian government enacted hefty taxes on the energy sector, while imposing rigorous regulations on the industry. In 1990, following years of political discussions, Norway's parliament established the Petroleum Fund, aimed at ensuring that the bounty from oil revenues would benefit both current and future generations. The fund received its first capital infusion in 1996, and as it expanded its investment scope globally, it transitioned to supporting the national pension system explicitly, culminating in its rebranding to the Government Pension Fund Global in 2006. The management of this fund rests with NBIM, the asset management division of Norway's central bank. How did Norway's fund grow so profoundly? Initially, the fund was supplemented by oil taxes, licensing fees, and profits from the national energy company, with its investment options limited to bonds at first. Over the years, its portfolio has expanded dramatically, allowing it to become the world's largest single owner of publicly traded shares. Importantly, the government cannot arbitrarily access the fund's wealth. There's a cap on withdrawals, limiting them to no more than 3% of the fund's total value each year. This regulation is intended to safeguard the wealth for posterity, with the residual funds reserved for further investments. When evaluating its performance against other sovereign wealth funds, the Norwegian fund's returns have been relatively middle of the road. From 2018 to 2023, it yielded an annual return of 7.45%, which, well below the Abu Dhabi fund's 10.1% and China's 8.6%, outperformed Singapore's Temasek at 4.5% and Korean's Investment Corporation at 5.2%. How has the fund's role evolved? The fund has progressively increased its equity investments while also incorporating real estate and renewable energy projects. It places significant importance on sustainability and responsible investing. An increasing focus on environmental, social, and governance (ESG) standards has become integral to its approach, a strategy that remains steadfast despite the U.S. administration's critiques of what they labeled as woke capitalism. What are the ethical standards guiding Norway's fund? Since 2004, ethical principles outlined by the Finance Ministry and endorsed by the Parliament have guided the fund's operations. An independent ethics council supervises these guidelines, which prohibit investments in companies connected to severe corruption, egregious human rights violations, or substantial environmental harm. Companies involved in specific armament manufacturing, such as nuclear weapons and cluster munitions, are also excluded. By the end of 2024, a total of 67 companies had been divested from the fund due to breaching these ethical guidelines. This list includes Adani Ports from India for its operations with Myanmar's military and Bezek for its actions related to illegal Israeli settlements in the West Bank. An additional 104 companies were eliminated based on the products they offer, as the fund's ethical framework forbids investments in industries like cannabis, tobacco, and coal. Furthermore, the fund shuns businesses contributing to unacceptable greenhouse gas emissions. Despite deriving income from fossil fuel sales, could the fund's investment strategy change? In the first quarter of 2025, NBIM reported a loss of 0.6% on its investments, which equates to a staggering $40 billion. This downturn has become more pronounced in light of President Trump's sweeping tariffs, igniting discussions in Norway about how to shield the fund from an increasingly unpredictable global economic landscape. Approximately 40% of the fund's equity investments are situated in the United States, prompting some Norwegian lawmakers to advocate for a shift towards more investments in Europe to mitigate exposure to the volatile U.S. markets. At the conclusion of 2024, U.S. bonds constituted about 9% of the fund's total assets. Norway's finance minister, Jens Stoltenberg, has maintained that the fund will adhere to its long-term strategy while continually evaluating risk management strategies. There has also been a push from Norway's conservative opposition to revise investment guidelines to permit purchasing shares in firms that manufacture nuclear weapons. Currently, these restrictions limit the fund's involvement in much of Europe's arms sector, which stands to benefit significantly as nations ramp up rearmament initiatives in response to Russia's aggression in Ukraine. Notably, Norway supplies about 30% of Europe's gas, with some politicians advocating for increased fund transfers to support the Ukrainian government. They argue that Norway's lucrative oil and gas sector has profited tremendously from the European energy crisis triggered by Russia's 2022 invasion. Additionally, fund leaders have been calling for an inclusion of private equity in investment strategies, an idea met with resistance from the Finance Ministry, which is cautious about the high fees and relative opacity associated with that sector. This debate continues to unfold. What becomes of the profits generated by the wealth fund? A portion of the fund's profits is directed towards supporting Norway's expansive welfare system, which encompasses free education, healthcare, subsidized childcare, and generous sick leave. Norway ranks an impressive third in the UN's Global Human Development Index, trailing only Iceland and Switzerland. In 2024, an estimated 20 to 25% of the national budget came from transfers from the Wealth Fund, with a proposed allocation of 50 billion kroner, approximately $4.85 billion, aimed at aiding the Ukrainian government. What is the Wealth Fund's impact on Norway and beyond? The fund serves as a financial safety net for the nation, providing stability during fluctuations in oil prices and broader economic challenges, thereby ensuring continued fiscal health for Norway. Furthermore, the fund's actions have helped bolster Norway's international reputation by advocating for sustainable business practices across the globe. For instance, in June 2024, the fund voted against Tesla CEO Elon Musk's exorbitant $56 billion remuneration, a decision that has stirred significant public discussion and legal scrutiny. The fund typically makes its voting intentions public 5 days before the annual assemblies of its invested companies, and took position counter to board recommendations in roughly 5% of shareholder votes throughout 2024. However, a significant contention persists regarding Norway's increasing dependence on the wealth generated by the fund. Critics argue that this reliance has led to complacency among political leaders and diminishing productivity within the workforce. They highlight troubling statistics, revealing a relative decline in national productivity compared to other affluent countries over the last 20 years. Moreover, government expenditures on subsidizing sick leave have surged, while the performance of students in standardized assessments has shown a downward trajectory. Norway's oil wealth? A blessing or a curse? Is it possible for a nation to be overly wealthy? The story of Norway's vast oil riches unveils a complex reality that often goes unnoticed when we think of prosperity. Back in 1969, Phillips Petroleum was ready to give up its search for oil on the Norwegian continental shelf, but in a surprising turn of fate, they drilled one last well and struck an incredible find. This breakthrough transformed Norway into one of the wealthiest countries globally. Today, its sovereign wealth fund, which was created to invest the revenue, oversees approximately $2 trillion. This astounding amount translates to around $340,000 for every single citizen of Norway. For decades, the influx of oil revenue, coupled with the robust wealth fund, has enabled this small Scandinavian nation to maintain impressively low unemployment rates, minimal government debt, and a comprehensive social security system that guarantees an exceptionally high quality of life for its citizens. But here's where it gets controversial. While many celebrate Norway's success, there are underlying costs and challenges associated with such wealth. The reliance on oil has sparked debates about economic sustainability and environmental concerns. As Norway enjoys its prosperity, could this create complacency or hinder the development of other sectors? What are your thoughts on the balance between wealth and responsibility? Do you think a country can indeed have too much wealth? Let's ignite a dialogue in the comments below.